But if I want to hop on board, I need that volatility to subside a little bit. There's not a lot of juice left on the bone potentially before you mentally have to start peeling. But sometimes with an NVIDIA, it takes 18 months, but she grinds 1,000%.
Hey, what's up, everyone? Welcome back to another episode of Trading Takes with me, Sam, presented to you by Investors Underground. Now, tonight, we've got another very special episode coming at you. Probably one of the most exciting and inspiring conversations that I've had the privilege to be a part of. In fact, we were recording until 2 a.m. my time, and I still couldn't get to sleep. Tonight's guest, Ariel, or on Twitter, Real Simple Ariel, has made over $10 million trading stocks in a relatively short space of time. And tonight we go through his strategy all the way from planning to execution. And for those of you who like real trade examples, there's plenty of those tonight. Ariel, how are you doing? Welcome to the show.
Thank you, brother, for having me, man. It's I feel like it's been a long time coming because you and I have been speaking quite a bit, probably for the last 6+ months.
Yeah, I mean, you're at the level that I'm striving to get to. You're predominantly a swing trader. And obviously you're very good at it. And obviously we're both mutual friends with Josh Cherniak as well. And he said, my goal, Sam, is I want you to be predominantly trading large caps. So it's great that I can have that conversation with you. And, I appreciate your time as well. Not just tonight, but all those conversations as well. And yeah, long time coming.
Absolutely. And I'm happy to be here. And honestly, Josh is fantastic. And I'll say this, don't give up necessarily on mid caps or even small caps when the market's hot. I think the important part that maybe Josh may have not mentioned to you, and really the small little nuance, is theme, right? Once you're on to a specific theme, and even a few, maybe a month ago when you had SIGA and GOVX and it was the monkeypox theme, you can get really big outsized moves. And that is how I grew my portfolio in 2020 and 2021 was themes, small cap, mid caps, that you would catch these, big percent moves. And you're just really not doing that in large caps. The thing that large caps provide you is the liquidity, right? There comes a point where, you're going to be trading with 7 figures or more multiple, and it becomes really difficult to move the portfolio meaningfully with day trading, even small, because you can only size in so much. Like, even if you were very comfortable on GovX, and you get to a certain point, you have 30,000 shares and you catch a majority of that move and $2 move. And for some people that might not move the needle, where if you're in large caps, and you catch a 10, 15% move, it had all the liquidity necessary for you to put, $1 million, 2 million, 5 million, 10 million into these trades and then let them work. And then, and really it's all scaling based on the size of your portfolio. You're not like, they might sound like big numbers, but you're not really ever doing that until, you're walking well before you run and you're crawling before you're walking. So, but I know why Josh says that. It's because the liquidity is infinity, but the percent moves you get in small caps, mid caps are bigger. Sometimes they're faster lived. You get the 40%, the 50%, the 200%, and then it's done. But sometimes with an NVIDIA, it takes 18 months, but she grinds 1,000%. And that, I think, not everything turns into NVIDIA. You can study something like ELF or Celsius or VRT or VST or CEG or any of the things that are currently themes. They already had really beautiful setups 10 months ago, 12 months ago, 16 months ago, and really strong, powerful mid caps, large caps. They're liquid and they do the same thing as things have always worked. They go up, then they consolidate, or they'll pull back, they'll build a new base, they'll tighten up, and then they'll re-break back out, right? And it's when things get really tight that you're beginning to hunt your entries, and liquidity is basically infinity. And, I was just reading some of what the short bear said, and he was talking about NVIDIA being a huge opportunity at the beginning of this year. And he was right. And I was there for that entry. I had a 495 entry, and then I had a $500 breakout entry the very next day. So I kind of anticipated the move because a smaller hourly time frame was already starting to get above all its key moving averages. And then on the daily, the next day you got that daily breakout, and then there you go. And I remember I actually missed SMCI, and all of the guys in the Discord are all in SMCI, but I was so big in NVIDIA that, again, this is looking back at it, I was a moron, but I was like, oh, it's a laggard. It's going behind NVIDIA. The leader always goes first. So I was like, I don't need to own SMCI. I've got NVIDIA. And then it was like SMCI broke out. And then about 4 days later, percentage wise, it's like already creaming what NVIDIA was doing. And I'm sitting here, NVIDIA 3.5%, 3% a day. And it's climbing, it's grinding. And you have a $500 average. It feels great. But obviously you missed the fast one. And then that's a huge opportunity missed. I did play it on the short side, but I also gave back the most amount of gains on the short side on that one. Like I was up huge, and then I gave back half the gains overnight, and then I did it again. And eventually I stopped playing it, and then you get the real big move. And at the time I had like 1,070 average. And at the time you're like, oh, this thing's too whippy up here. And then it finally breaks down 800, 700, gets really tight at 600. Fails, rebounds. Now they're not filing a 10K, another 100-point dump. And you're just like, so many great opportunities. And I was like, man, I once had 1,076 was my average on the short. and now you're like, I don't want to. How weird is it psychologically when it spikes to 1,200 in your mind? You're like, that's the top. Like, this has gotten absurd. And then, it's not till months later where you're like, man, I don't really want to short it at 700. I had it $400 higher. And then, it still ends up, going another 40% lower. So I think sometimes I got to like work myself out of that own mentality that like, just because something's gone up too high doesn't mean if it doesn't tighten up and give you a tight entry that it's not good. Like I bought NVIDIA today. My first entry, it's funny because I bought NVIDIA today, $117 and then $120. My first entry on it was $167, I believe, in like December of 22.
All right.
And it went from 167 to 230. And I was like, all right, this went up too much. And I let it go. And all these times, it's like watching NVIDIA still go higher and higher and higher was like, this is why we really have to swing. This is why we have to size them properly. This is why we have to let moving averages work, because I don't really truly know how high something can go. I think what became difficult for me to figure out was, how do I sell something so that I can capture most of the meat of the move? And then I just started to say, well, if I'm using moving averages, like if you just looked at 1,000 charts, roughly how extended do they have to get from those moving averages for you to say, hey, if a stock moves 4% per day and I'm using the 50 simple moving average as my guideline, and I say, hey, the stock moves 4% per day and it's up, call it 28% from its 50 day. Then I would say to myself, it's if every day it moves 4% and now we're 28% from the 50 day, we're 7 times its average daily range away from the 50 day. Right now, mathematically, we're starting to get extended. Once I'm getting to 7 times, 8 times, 9 times, 10 times, I really want to make sure that I'm scaling into that, right, on a daily chart. And then if a chart moves 4% per day and it's less than 16% from the 50-day moving average, I'm still comfortable buying it, but I'm sizing down. Ideally, I want to be buying something as tight as possible in a chart pattern and to the 50-day. And we could even look at like NVIDIA as an example. When I'm buying something, how extended is something? And I think it all just, for me, it just became a mathematical thing. And this is something that I've studied. It's just when something gets over 10 times its average daily range above the 50-day simple moving average, it's almost an unsustainable move. So it's something that I know I have to be peeling off a chunk of my position into strength, usually over 7 times its average daily range. And the same is true, like if a stock moves 20%, like it's some low float, or like an NNE, it can get wildly extended. But when they move 18% a day and now you're 200% away from the 50-day, which can happen, you're still only 10, 11 times its average daily range away from the 50. You need to be peeling aggressively, but moves like that are impossible. And those are kind of the moves that I'm personally waiting for to be peeling completely into strength. Then again, if a chart is really pretty, but it's 6 times away, its average daily range away from the 50, I don't even engage in it because the likelihood of it succeeding, is very low. And what am I really shooting for? Another 1% average, or like another 1 times its average daily range. Again, if a stock moves 4% a day, or 3.5, like NVIDIA 3.66, and you're up, call it 4%, and you're up 24% from the 50, there's not a lot of juice left on the bone potentially before you mentally have to start peeling. And you look at a chart like NVIDIA today, it's less than 1% from its 50-day, and when it takes out yesterday's highs, at this point you're less than 1% from its 50-day, roughly 1%. You're buying 117. If you're waiting for 120 to break the range and add to your position, you can. And then again, simply for me, all stops become low of day anytime I take an entry. And how do you know that today is the day to buy NVIDIA? Well, one, price, right? It's no chart. Like, I don't want to anticipate that something has to happen, but when price takes out the prior day's range, right, it has to do that first in order to establish itself to meaningfully go higher. But then on the daily chart, everything's very tight. And I've always had like this little saying in my head that birds of the same feather flock together. I'm sure you've heard of something like that. So it wasn't just NVIDIA, right? It was ARM that had a very similar chart. It was TSM. So you look at ARM, I'm gonna link these here. So you look at ARM and you can see, again, a move up and then a sideways consolidation getting very tight. TSM, a move up, a sideways consolidation for, on the hourly chart. And again, the charts are effectively the same thing over and over and over. So it's a move up, a move sideways, get tight, and that's where you can limit your risk. And then you're buying it as it's breaking a range. Usually for me, it's an entry over prior day high if I'm looking to buy a breakout. There are a few other entry tactics, which you could buy an undercut and rally, which is like you might break a prior day low and then you start to reclaim. And then I'll use like a 5-minute, time frame where I've always respected Lance, and he coined it as the right side of the V. So it's like you get that move down into prior day lows, and then you start to get that reclaim of that prior day low. The tape isn't as heavy anymore. Maybe you're seeing a few more bids. Maybe you're seeing a big wall on the ask that just is getting chewed up. And, I like to see big walls on the ask. Everybody's like, oh, that's super bearish. If it was super bearish and that big wall on the ask really wanted to get out, they'd be selling to the bid. But if they're just sitting on the ask, right, they almost know they're going to get filled, right? So I love seeing big walls on the ask. I know it sounds silly, but then when you break through them, you get that nice little burst right through, and then you see another big wall, and the bid is very thin, and you're like, oh, this is just going to get knocked right back down. Gets knocked down a couple pennies, soaks right back up. Now you're right back up against that big wall, and you'd be thinking like, oh, I want to front run that big wall, is maybe to short it, and I've done that a zillion times, and let me tell you, it doesn't work.
No.
Just right through the wall disappears, you're pushing right back higher. And I look for that little right side of the V capitulation against prior day lows, against a prior left side on a daily, and then, play it back through. And then once it gets through moving averages, maybe add. But the key, I think, for swing trading, and a lot of swing traders know this, is you have to scan the market. When I was a day trader, I was cash every single night. I would come to the computer the next day. What's gapping up? What's not? What's got news? What are some levels? What are the stocks maybe showing the most relative volume? Let's scalp those if we have to. Fine.
Yeah. So what's the process then for that then? Like your nightly process to scan? Because like you said, like for a day trader, and I don't want to assume our audience is like more day traders than swing traders, but I think everyone is interested obviously in swing. I certainly am. So what does that process look like for you? Like, I don't know, is it typically an evening, for example, an hour a night kind of thing? flicking through obviously what happened during the day, etc.?
Yeah, so it's a combination kind of all of it. I like to scan, in particular, the evening. The market's quiet, it's turned off. Maybe just the futures markets are going. So you kind of get a sense of, the futures are coming down a little bit right now. Some of these positions that I like for longs, maybe we get a small little gap down in the morning. We get to see if we get that morning strength. But it always starts with scanning. The first scan that I like to do, I scan for my 3-month relative strength scan. So I like to know what charts are actually holding up best over 3 months. And literally, if we go just right from top down, I am sorted then by the most liquid. Some names are holding up better on my list, but I want to look at the most liquid ones first. And obviously, the best and most liquid name in the market is Meta. And then recently you've got Baba and you've got Visa getting absolutely hammered. Netflix making new highs. And Netflix is another great, beautiful example of the exact same thing we look for. It's just a move up, a pullback. You almost get this nice flat base right around, $710 roughly. And you could just be playing it for a little breakout over those highs, right? A breakout move to all-time highs. And you're doing it. I think it's really important to take this into context. When you're buying something with the market direction at your back. Yes. Do I think Netflix and Meta and NVDA, Apple, Microsoft, do they all just go higher eventually if you just close your eyes? Yeah, probably. But if you're trying to not really guess and get into the green right away, you want to buy something as it's leaving a tight consolidation. That's how you're going to limit how much risk you might have when you initially open the trade. But then I want to buy something on the day the market is at my back, right?
Yeah.
When the market's going down, that's a really great time to scan and say what stocks are holding up best. But when the market finally begins to go up, the ones that were holding up best during the correction are the ones I really want to own coming out of the correction, right? You could look at a software name like Now, and it was getting the market was getting absolutely smoked there for a moment, and now still hanging out near 52-week highs, right? You look at a name like Netflix, the market's getting smoked and very quickly hanging right back out near 52-week highs. Any names that are hanging out near their 52-week highs when the market's going down are the most likely names to advance the most when the market's done going down. And then the inverse of that is true too. When the market's going up, the names that are going down are the names that I would like to short, but I don't really want to short when the market's going up. I'd like to do it. I'd like to engage in a short position when the market gives me some distribution, not like a day like today, right? But on a day in which the market's actually coming down, I don't then just want to short the names that are most extended and highest up and have been showing the most strength. I want to short the names that have been already showing relative weakness for days and weeks at a time, right? And you could think of a group right off the top of your head, I'm sure, solar names, and say to yourself, every time the market was incredibly strong, those names were showing relative weakness. The minute that the market showed any relative weakness or distribution, those were the names to get crushed the most, right? Then the market would turn back up and maybe those wouldn't get crushed anymore. Those would just go sideways, but their initial move was down. So the same thing is true for longs. The initial move is up, then the market, maybe pulls back and the best names will just kind of go sideways. Then when the market's done going down, the best names will go the highest. And again, I like to buy when things are on sale, right? Not the stock on sale, but the stock market on sale, right? Because once the stock market stops being on sale, you're no longer dealing with any market headwinds for your swing positions. So when I recently bought CPNG, CORZ, NVIDIA today, Tesla a few days ago, you're really not getting any market pushback because the market bottomed a month ago, right? It had the huge washout, what was it, August 1st? We had the V-shaped recovery. Everybody thought we were going to wash back out. Semiconductors did a double bottom against their 200, and they're the maybe biggest group for institutions right now, semiconductors. And so those names got supported, and it wasn't just semiconductors. It was, CrowdStrike finally washed out from 200 and recovered, another $100 of that. Pan W did something similar, and now you've got themes, right? You've got the energy theme, you've got the powering data centers, like with CEG and GEV, and again, GEV, another absolutely beautiful chart, right? You get this really nice sideways consolidation, and you start to say to yourself, hey, outside of this, and some people will call them Darvas boxes, some people will just call them consolidations, whatever people might want to call them, but you could look at a day very simply like 828, and you could see how absolutely tight. You get a move up, and then you get a sideways consolidation. On 828, you have an incredibly tight day, and then you get the breakout, on a breakout over prior day highs, breakout over the little range, and you're buying anywhere from 186 to 190 with a stop at low of day. I think the biggest problem that maybe most traders have, and I've had this problem myself, is sizing properly. I came from the day trading background. So when you're only trying to capture a, 3%, 5%, 12% move, you oversize it, right? When swing trading, you don't really know how far something can go, but to truly be able to hold a move, you have to be sized properly, right? If you've got 50% of your account in GEV, the first downtick's going to shake you out, right? Literally a few days after you would have bought it, you'd have gotten a nasty shakeout. If you bought this thing on 829, holding it on 9.3 is going to be very difficult. But if you only have 10% of your portfolio at work, and again, if you have a $1 million account, you might only have 500 shares here, 500, 600 shares here. So in order to really make money, right, you would have almost needed it to go on that 60-point run that it went on.
Yeah.
Right? In order to really, make 30, 40, like in order to make some good money, you'd have had to have held a big chunk of that move. And mind you, even after that one little kind of shakeout a few days after you bought it, it never broke below the low of day or even your average of the day you bought it. Mostly it never closed below. And then it just held the 10 and the 20. It even held the 5-day moving average. It's still above the 5-day moving average. And again, when you're a day trader and you oversize something, it's very difficult to hold the entirety of that move. But when you're swing trading and you're sized properly, no one position is going to move the needle on your portfolio. It's going to be very good. It's going to be healthy trading in an even better environment, like you seeing things well, but you're no genius. You're in a good environment. And, again, it's not like a lot of people didn't see GEV breaking out over 185, 190. It's that if people wanted to get in, maybe they bought too much and now they're not in anymore. But people who are properly trading, and I know several guys who do own the name, right? I've got a couple of guys who I talk to frequently, and they manage some money for clients and they own this stock for clients. But when they buy for clients, you can only own and buy so much safely, so you're not blowing up, your client's money. But if you do it properly, now you're still in it. And you'll notice that a lot of the names, for example, that I'm in, they're basically the exact same thing. You get this exaggerated move up. You get several months of consolidation. When this thing got nice and tight, I bought cores on 912. And the thinking was with cores, while Bitcoin was pulling back, cores was still going sideways. And I told myself, if the Bitcoin sector begins to turn up, who are the names you'd want to own? Well, there's IBIT, which basically mirrors Bitcoin. There's MSTR, which is very leveraged basically to Bitcoin. And then cores, Iron, Wolf, we've seen those go on pretty big runs over the last several months and have big pullbacks, but start to set up again. And you can look at Wolf, another great example, and of why maybe you don't necessarily have to give up on mid and small caps just yet, and you can still swing them. But the thing is with like just owning Wolf is it fits a theme. And a theme is very important. It's the juice behind the stock that you buy, right? It's going to be that thing that really gets your stocks moving. It's a theme, good earnings, sales.
So just touching on that then, like the themes that emerge, obviously it helps to be, I guess, I don't want to say early, but you have to time it well in that, like, everyone now can look at NVIDIA and say the theme of this year is AI. Like, it's not, at this point, it's not difficult, but perhaps earlier in the year, like, you could be a massive skeptic and be like, I don't think AI is going to change the world or whatever in the next 5 years, whatever. But equally, that's not what the market said. So
right.
I guess on that point is like, how you, like, recognizing these themes, I'm sure it's on your scanning process, but how are you recognizing those themes as and when and getting that timing right?
Yeah. So actually, I learned this lesson very early. So I became a swing trader 2022 and January 1st, 2022. And coincidentally enough, I became I became a swing trader. What I thought was at the perfect time. But 2022 was miserable. But at the very beginning of the year, through scanning, I noticed a setup in these energy names. And I said to myself, like, remember the birds of the same feather flock together. Yeah. All of these stocks had, Sam, I kid you not, identical setups. And we will run through a few just so you can see. So this is the ETF, XLE, right? And I will not forget it. And you know what? I will even extend my time frame just a little bit more. I'll go 5 years on this XLE ETF. Okay, so now we're coming into, January. How far back did we go here? Okay, here we are. All right. So this is, and it's funny because, Sam, I kid you not, every single one of these names I'm about to show you had the exact same setup. So when I'm scanning, I'm like a kid at the candy store the next day. I've got alerts set. And I remember I bought XLE, $56. I did it perfectly. And I bought this thing on January 3rd. And again, very simple. You had this thing basically bottom out right at the 200-day moving average in 2021. And it had found support right at the rising or flattening 200-day. It makes this nice little move up. And then you have this little pullback right basically into year end. And of course, you get that little washout. And you've seen this washout now probably on every single name we just traded recently, where they have these washouts right to the 200 and they find support and they rip right back up. Well, right before it took off, you'll notice December 28th, 29th, 30th, and the 31st had this little 3-day pullback. On the 31st had this little up day, and on the hourly time frame, it's about as tight as you can get. You can draw this little tight trend line right in there, and you could see the moving averages. They're stacked right on top of each other. So This was XLE, the energy ETF. And for example, this was DVN. And at the time it was one of the stronger names. And this was, you get your move up, you get your 3 little pullback days, you get your 1 day up, and then you had your breakout. And basically this was kind of like almost like a flat base breakout. And again, your entry would have been like 44.30s all the way up to even the close. If you just bought the close, $45. And that was DVN. You had FANG. It was the identical, and I mean, I kid you not, the identical setup. You had this nice strong move up off the 200, this little washout, still well above the 200. Again, these little 3 red days in a row. It's like the exact same candles. And part of it goes, why do charts put it in the exact same candles? Because it's the same institutions buying them. It's the same institutions not selling them. So it's gravity just taking over. Maybe they're not showing up to buy. Something gets really tight, and then you're not the only one who notices that chart pattern. A lot of people who have that pattern recognition and are recognizing that energy all has the identical setup, they're there to buy it, that day. And then, institutions also finishing out their positions for the remainder of the quarter, for the next 6 months. And that's what drives a stock higher for months and months. That, you look at VRT or VST or ELF or, Abercrombie. Abercrombie was $35. The thing goes to 200. Sometimes it just takes institutions quarters to finish out their position. You don't know how long it's going to take, and you don't really know their time horizon, but it's them buying that kind of creates that picture that you're seeing. And for energy, everything had that exact same picture. And so when I'm scanning, here's ConocoPhillips. Look, your 3 little red days in a row, your 1 green day, very tight. And if you study pretty much every single energy chart, 2022, January 3rd, that was your breakout day, your buy signal for pretty much every single energy name. Now, granted, I did get shaken out. I was like a new swing trader, and I got shaken out pretty nasty in some of these because a lot of them did have a pretty nasty shakeout, like something like Oxy right down here. And I remember it was bad. It wasn't right here. It was like right before this thing went even higher. I don't remember what it was, but I think I closed this nasty red bar. And sure enough, you're like, oh, all right, well, move from 30 to 38, 25%, not terrible. And then the thing ends up at, another 100% higher. Yeah. And it's the same thing. It's the same thing. I kid you not. You can even look at a chart like AMR. It's probably one of the best examples that I can ever remember. You get finally something gets over its 200 day, and it goes sideways and breaks over its 200 day, and then continues to grind higher, pull back, go sideways, get tight, grind higher, pull back. I don't really ever want to look at a chart below any key moving averages and say to myself, oh, this thing's gotten too cheap here. It's time to buy some, right? Like I had somebody, sorry for interrupting. I had somebody ask me today, hey, Ariel, you see semis going. Do you think AEHR is going to make a comeback? And let me just, for example, pull up AEHR. And then I say to myself, look at this thing now well below its 200 day and trending below a declining 200 day. And then look at how NVIDIA was tight above all key moving averages. Yes, can AEHR go if the entire semiconductor sector just catches heat, right? Where ALGM and LSCC and ACLS and everything's just ripping. Could AEHR go back to 20? Sure, it could. But it's got tons of overhead now, and it's not a leader, right? The very best stocks are going higher or sideways when the market's coming down. And then when the market's going up, they're outperforming. And when the market's coming down, they're outperforming, right? When AEHR, the market's basically at new all-time highs, and AEHR is back to 2-year ago prices, right? That's not a chart I ever want to focus on because it's not outperforming anything.
Yeah,
Yes,
it makes a lot of sense. Like, why deploy any capital there when you just named 10 better opportunities?
Right, because for some people, it's gotten too cheap. And the last time NVIDIA was at $120, right, AEHR was higher, right? Or some people will say, well, NVIDIA's up even another 100% when AEHR was at 50. Now AEHR is at 12 and NVIDIA's up 100% higher from there. Like AEHR is going to eventually go to 80, 90. It's like, I don't care about that at all, right? I want to find when a stock is on my 3-month relative strength scan. Yeah, like I look at BABA. And, obviously the time to have bought BABA, and you could even look at this little setup. It was very choppy, but you could have bought, like, you had this little move, you had higher, low, and you could have just drawn a very straight line, basically right over 86 bucks, 85.70, and over 85.70, maybe it's a good long. And again, you're now looking for an intraday entry, and with the gap up that high, it's a little tough unless it's like an earnings gap up, but that was the time to buy it. Now they're a bit extended, and I look at it and I say BABA moves 2.24% per day, and it's up 15 bucks from the 50 day. So, percentage wise, we're getting there, and now wouldn't be the time to be buying BABA, right? Just because, like we talked about, it would actually be a time to be trimming BABA, not buying BABA, just based on its extension from the 50 day. And, that's very important. And, kind of, once you're thinking about that. So if you think about the 50 day, it's 82.42. So it's, pretty much down here on the daily. And so 18% basically in terms of price from the 50 day. And this thing moves 2.5% per day. So we're effectively 6.5 times its average daily range from the 50. Yes, BABA's going up, but for a new portfolio position for swing trading, no way. Absolutely not. And I think, again, that is sometimes like little nuances like that of like when to get involved, when you don't, when to pare back some risk and take some of your chips off the table. And there's nothing wrong with, if you just look at BABA and you see the relentless higher lows against moving averages, right? Now my thinking becomes, hey, when this thing retraces back to an ascending moving average, just like it did every one of these times on 815, 828, 99, and it finds support at those rising moving averages, right? If you have another entry tactic, using a smaller time frame as something's approaching a daily level, and then zooming in on a smaller time frame, like a 5-minute chart, and then looking for that, that right side of the V capitulation, or looking for that little move up off the lows, small consolidation, maybe back over VWAP, something like that, maybe a red to green off of that area, and knowing, hey, it's a bit extended right now, but China's a theme. China's in play. You can look at Lee. You could look at JD. You could look at BABA, FXI with the largest upside volume in history today. Those are clues. And how much further can something go? You and I have no idea, but now's not the time to engage. But it's already proven to you that, for instance, BABA is finding support at rising moving averages. When it gets to a rising moving average, it'll still be on my 3-month relative strength scan. And when I'm scanning at night, I'm going to say, hey, look at this thing resting right on the 20-day or right on the 50-day.
Yeah.
Like, I'm going to take a look at this thing tomorrow and see if, this is going to maybe give me a little red to green, or maybe a break over prior day highs, or maybe a break back through that 20-day moving average. And all of those, as long as you've studied that entry or you're limiting your risk, you say, hey, when I enter here, I know where I'm getting out. But most importantly, it fits the theme that you've scanned, right? Right now, China's a theme. Right now, gold and the silver miners are a theme. Right now, anything to power AI data centers is a theme. Semiconductors with TSM, NVIDIA, AMD, it looked like they could be maybe coming back as a theme, the semiconductors. I saw iron today. I saw cores recently, Wolfspin acting well, the whole data center that isn't maybe a crypto miner, like Riot, you look at it, CleanSpark, you look at it, Mara, you look at it, they don't look the same. They are totally different charts. You look at cores, CORZ or MSTR, and then you look at Riot and Mara and CLSK, and if CLSK was keeping up, it'd be still at 17, consolidating, like still chopping everybody up, waiting to go higher. Yeah. But it broke that 15 level, and it washed all the way down to 9 or whatever the hell it was. And it doesn't act like Wolf or MSTR or Core. Like Cores is less than 5% from all-time highs, right? For CLSK, just to get back to where it was 4 months ago, it has to go up 100%.
Yeah, that makes so much sense. And just to take it back a bit, so you've touched on moving averages. Obviously, they sound like a really key part. I guess the question to you is, in terms of the nuances that you've explored with moving averages, how have you come up with your process? Because I know you've touched on the 200, you touched on the 50. It sounds like they may be the two most powerful. And I guess as an add-on question to that, is there a difference when you see that confluence? Like you touched on a chart just a second ago, and there were 3 or 4 moving, crossing over.
Super tight. Everything is so tight. And I've heard some guys call this like a launch pad setup, or the power of 3. Okay, so for swing trading, in particular, when you're dealing with small and mid caps, maybe small caps, I really only want to be trailing the 10 and the 20, right? I don't want to give a chart the ability to get super far away from the 50 and then retrace all that move back. But if it's something slower, like Lilly, NVIDIA, AVGO, Netflix, Meta, Google, I want to give these great companies the benefit of the doubt. And if you're above the 50, right, like when Abercrombie finally had that breakout at $35, it gapped up big volume over the 200, over the 50, around $28, and then just trended higher above its 50 and didn't bother to close below its 50 until 4/9 of 2024 at $120. And yes, when it reclaimed the 50, it then went from 120 to 196. So do I want to stay in something that's below the? Now, here's the thing. If you bought the earnings gap up at 28 And then the next quarter, it gives you another earnings gap up on 823 at $50. And now you're in it, right? And you've trimmed some, at 90, 100 because it's tripled for you, right? And maybe you only have a very small portion of your position left. But mind you, it's tripled in size. So it's actually not only moved the needle of your portfolio, but if it was a 10% position to begin with, by the time you've gotten to trim at 100, it's not a 10% position anymore, right? It's a huge portion of your portfolio almost. But you're not using the daily anymore. You might be using a weekly chart. And that's what you allow great earnings. And here's the thing, you can go back and study this. A lot of people have, but like earnings winners, if you catch the very first earnings gap up or that first change in character, it can go on for 18 months. You think about it, NVDA, it's been about 18 months. All these semiconductor names, Meta, Netflix, it's been roughly about 18 months since they've bottomed, and they're still going. Now, I don't know how much more these things may or may not have in the tank, but some names can last about that. Again, you don't want to get too cute with holding something for too long because you can end up in a situation like ELF, where it breaks the 50 and tries to reclaim and breaks the 50 again. And once it does, it then finally loses the 200. And if you get too cute with it, you go from 220 all the way down to 111 very quickly. So you do have to have some rules to get you in and out. If you're trading much slower names, maybe 3% average daily range or slower, like a Lilly and Novartis, the 50 days good. If you're trading something faster, even like ELF or Celsius, which is like 5% average daily range or more, the 20 day is probably, or the 50 day at max. Something that's acting really good on earnings and has been acting good on earnings deserves the benefit of the doubt. And most stocks, they'll like I'm sure you noticed Celsius long before it topped and how strong it was and how many, seems like million entries it gave from $10 all the way to 100 or even more because it actually split. So like $10 to 300, it gave over the course of a couple years a bunch of great entries, but eventually the music comes or the music stops for every stock, and you have to have some kind of rules to get you out. I don't want to be ever engaging into any swing trades on stocks below the 200 day. I prefer my stocks to be above the 50 day. The 50 day is what I personally use as a percentage gauge to gauge how far something is extended from the 50 day to know to trim or not, or to not engage in a position. I don't use the 200 to trail. I just don't engage in new swings below the 200. I use the 50 just to gauge how far something is extended and if I should engage in anything 4 times its average daily range above the 50, I just won't do it. If it's a small cap, maybe just size down because you know that they can get up to 10, 12, 15 times average true range away from the 50. But like a mid cap, large cap, once it's, if NVIDIA was less than 1% from its 50 day, but if it moves 3% per day, it actually moves 3.6% per day. If it's 4 times its average true range away from the 50, you're 14% away from the 50. So for example, if I'm buying NVIDIA instead of today, I'd basically be buying, it like 14% higher. Imagine that I would be opening up my swing at $130 plus instead of 120.
Yeah.
Right. Like the meat is off the bone.
Yeah.
Right. If it gets to 130, I want to sell some there. Right. But if it's 4 times its average true range away from the 50, it's like, I would be buying it at $130 plus. It's like, it's not to say that it can't go higher, but like you're leaving a lot of meat on the bone there.
Yeah, I suppose as the further you go, the odds just, it's not saying it's impossible, but the odds just begin to go against you. And then
think about it like this. If you're going to jump out of a window, because that's what stock trading is, you want to jump off the 10th floor or the 1st?
That's an interesting way of putting it. Yeah.
If I fall I want to fall off the 1st, not the 10th.
Yeah, such a
and that's like the best way to put it. Like if I'm wrong today on NVIDIA, even if I'm using, yesterday's lows as my stop and 117, and I actually bought it today, 117, got stopped out low of day, and then rebought it as it went back through prior day highs. Like it just started ramping. I was like, what is going on? So I bought some, sized down a little bit compared to what I bought in the morning because I was already took a loss on it. And then I was like, okay, 120 is kind of my level. It can get above 120. I'll add a tiny little piece, which is what I did. And so I still use a stop at low of day. But like, even if I'm wrong, we're talking less than 3%, 2.8% wrong essentially from my average. And again, I don't have 100% of my money here. So, and even if you did, some people, when I was day trading, I would sometimes have 3% red days. I know all too much about that with day trading, you oversize things, but.
And obviously you touched on then like stopping out of position, then re-entering then. So, I mean, what's your criteria then with that? Because obviously like if you're coming from like a day trader mentality, you're quite used to stopping out, re-entering, or particularly if you're shorting like a small cap or whatever, it goes a bit higher and you re-short.
And then you like stop half out and you re-enter a little higher and you recycle those shares or something.
Yeah, exactly. So how's that working for you then? Because obviously like the cost of missing a move, like say like, if we had this conversation next week and NVIDIA's 130, 135, 140 or whatever, you'd be absolutely kicking yourself if you'd entered today, got stopped out of lows
and didn't
re-enter. Yeah.
So I actually, this is straight from Christian Koulibaly himself. And he says, if you get stopped out, but it re-triggers and it's starting to break back through your range. And that's the most important part. When I first took it, it was trying to break out over prior day highs. I got in and it instantly got stuffed. And I was like, well, that's not fun. And so I was like, all right, I'm on the sidelines, but it's like hovering right on this 50-day. I was like, if this thing breaks yesterday's lows, it's now below the 50-day. Like I just longed it, but if it breaks prior day lows, like I might have to short it. And so like, I'm ready for that because it's breaking prior day low and the thing was very tight. And if you're going to live below the 50-day, I would short it. But it started to ramp right back up and right back through prior day high. And I was just like, okay, now the difference with when NVIDIA started ramping the second time, few things. One, there was this tiny piece of news that Jensen Huang was done selling shares. Stupid, totally irrelevant news, but that's the news that was being circulated. Two, TSM, AVGO were starting to go, and the market was like pulling back kind of ugly, and so was NVIDIA at the time. All of a sudden, NVIDIA starts to get through that key level, and I'm looking at the ES and I'm looking at the NQ, the futures markets for the SPY and the NASDAQ, and they're ripping. And I'm like, all right, well, if that's going to happen, and mind you, at the time, it wasn't just that, like Google had turned back up, AMD had turned back up, ARM was looking really great, TSM gapped up big last, another semiconductor name, AVGO still looks really good. So I'm getting evidence from other parts of the market. I mean, and even at the time, like when I see, it might sound totally stupid, but I see Bitcoin ramping up. And when I see Bitcoin ramping up, I know there's speculative money flying around. I'm not second guessing taking that entry because it's not like I took that first entry with 100% of my money and took a 3% portfolio loss and then did it again and then got my money. No, it's like I took like less than 0.25% portfolio hit, literally less. And I'm prepared to, take my next trade because it's still triggering. And again, if NVIDIA comes back and stops me out flat, it is what it is. But if NVIDIA goes on to work, and goes and makes a new all-time high and goes to 150, 160, 170, that's almost what it has to do to make this an incredible trade. Otherwise, it's just any other trade, right? As a day trader, you cut trades all the time for flat, small red, right? There's only one trade that is unacceptable in my book, and that's big red. And that's why I wait for things to be incredibly tight, right? That's why I wait for that sideways consolidation, right? That's how I limit my risk. But because of the way you size, things actually have to move right? A good amount in order to like really move the needle in the account. Otherwise, it's just, I forget about, like, if NVIDIA came back and stopped me out again to, you know, today, and then I had to buy it again tomorrow, those first 2 losses, it's one of a gazillion little tiny losses that I take all the time. So it's like, you're allowed to have really small red, really small green, and tons of flat trades. Because once a stock starts to work for me, like NVIDIA is, I'm not maybe using low of day anymore. Like, I will not be using low of day. I'll be using something like my average for my stop. So I'm comfortable it coming back to flat and getting stopped out. Now, after something works for it, once NVIDIA pushes 4%, do I have to have a low of day stop anymore? You don't have to. Could you? Sure. It's still a really small loss, but that violent move higher, now it makes me want to put my stop at flat. That's exactly where my stop. And so so now really the 3 trades that I take most often are effectively off the table. It won't be small red, it won't be big red, and probably won't be flat. You know, the likelihood is that it'll be small green or it'll be very big green, right? But very big green is if it goes on this really nice trend, you know, like when it went from 500 to 900, which was like my final sells, like 9 something. And believe me, I was kicking myself. I didn't hold it all the way to 1400. But it doubled, and the doubling is what made it a really nice trade. Had it gone up 10%, wouldn't have made a difference. It literally wouldn't have. I would have just been trailing it on an ascending moving average. But sometimes, like even on shorts, like today as an intraday trade, I shorted Palantir, and you know, off the open, and I was expecting some kind of a bounce, and the thing just never bounced, and I was like waiting for a bounce to add more, and the thing never freaking bounced, and I was just like, fine. Forget it. I won't add anymore. Like,
this is one of my favorite sayings. I always say the best ones don't bounce.
The best ones don't bounce. But you want to add so bad. But I've been caught in that stupid V-shaped recovery a couple times.
Well, there is that. Yeah.
I was like, all right. I was like, I'm not going to add, but I won't. And I knew it was just going to be an intraday trade. But I said to myself, like, I won't cover until, and I take my entries like this, and sometimes I take my exits like this too. It's when the 6 EMA on a 5-minute curls back up and gets back above the 20. And so once your 6 gets back above the 20, you know, momentum's kind of starting to flow back up. I just cover it. But I was waiting for the thing to like come, maybe retrace the VWAP, give me a chance to add. Nothing. The thing just dumped $1.30. And I was like, well, I have no size, but the best you can do is just trail it on a smaller time frame, and that's it.
So let's just touch on that. So I think there's a couple of things to add there. So on just going back to like the NVIDIA example from today, from like and like just to like break it down, because I don't know, this is always a question that's always hot in mind. So you touched on like the break of 117 and the break of like 120. Mm-hmm. What does that actually look like in terms of like the execution? In terms of like, are you just going bang on a type of trade like like you see 120 flash, you're like bang, I'm in?
No. So really what I like to see, especially like when I take all my entries, they typically occur on a 5-minute chart. So, and I'm always using level 2. Like if I scoot my screen back, I'm sure you could probably see all of my,
it's pretty busy.
Yeah, you could see. So I am keeping an eye on, you know, my level 2, but really, I mean, when I've used a moving average, my focus is really just that moving average. Are the smaller time frame moving averages trending up? Are the moving averages on the daily very tight? And when I'm taking that entry at 117, I already know as I'm taking that entry where my stop is. So I know, hey, based on, you know, with my 117 entry and how much size I'm going to take, this will be my loss when I'm wrong. Right. Yeah. And I'm wrong so often, I pretty much just say to myself, there's about a 60% chance right now that you're going to end up, that this will come back on you and stop you out low of day. But I had that, you know, but I'm sizing in properly and the market direction was at my back. Right. And like I said, if you look this morning, TSM with a big gap up, and all of China names had a pretty big gap up, even though TSM's from Taiwan, but you know, you had TSM with a big gap up. You have AVGO still looking fantastic. You know, I want to say it was KLAC, the one that I noticed was still acting. Yeah, that's still shaping up. SMH is still shaping up. So it's like semis are still looking pretty good. And I've always thought this before. They look like they may be wanting to break down, but when something doesn't break down, it has a fast breakout. And when something doesn't break out and it has a failed breakout, it turns into a super fast, like failed moves come fast moves, right? And the same thing is true for the short side. Like it looked like NVIDIA was really weak in the morning and then boom, came a really fast move, almost a little too fast for me to just take it all, but it's turning up. And I'm, the other screens that you're not seeing, around me, I'm looking at all the futures markets. I'm looking at relative, like if I'm buying NVIDIA, I'm not just looking at NVIDIA. I'm saying to myself, what are the Qs doing? Because it's the most important tech name, and what's tech doing? And then I say to myself, if tech's doing all right, the QQQ, because I don't just want to buy NVIDIA when the market's getting flushed out. I want to buy when the market's on my back. I'm looking at the Qs, and then I'm looking at other semis, and they're going up, and it's breaking a key level. Just because I got stopped out, I'm happy to rebuy it back. And yes, I'm looking at level 2. Again, I started as a day trader, so like I live on that thing. I just really want to see, maybe 117 break, maybe wick back under 117, and it gets soaked up really quickly. And then all of a sudden, if there's any kind of wall on the ask, you're just chewing through those. I told you what I like seeing before. Some people think it's bearish. I like seeing fat walls on the ask. Inversely, when I'm short, I don't want to see a super thin bid. I like to see a wall, and then I want to see that wall get taken down.
Yeah.
If the person who's buying on the bid was so anxious to get out, he'd be buying the ask. But if he's just sitting on the bid and he's a buyer, he knows he's going to get filled, which means it's going to go lower. And I've always saw that, like when I see a big print on the ask and I'm like, hey, that's like $1 higher. That's 50 cents higher on AMD or NVIDIA. I'm like, this thing's probably going to that level to take, that ask out, take that wall out. Yeah. And it's always my thinking. And I'm using level 2 to my advantage. Not everybody does that, because the reality is, the truth is you don't need it. You do not need it. You can go back to, and I've had this discussion with many other traders. You can go back to November 1st, 2023, last year, when the market gave us a follow through day. The market was washing out all of October, and all of October, while the market was going lower, 3 waves lower, cybersecurity was going perfectly sideways. And that was your leading group, right? And CrowdStrike went from 170 all the way to 400, months later. PanW went wild. Zscaler, ZS went nuts. SNPS, another cyber name, went wild. But more importantly, the reason I say you don't need level 2 is because if you understand, and I've told you, I like to buy stocks that are holding up best when the market's coming down. When the market last summer came down 10%, and then now all of a sudden, coming out of that correction, you had AMD responding really well, getting back through $100 on earnings. You had obviously all the, and even like NVIDIA, it had already made such a big move. It was still finishing its consolidation. But at the time, you had like Uber making a really nice move from $40. You had Shopify with a nice gap up. You had for earnings play. You had AMD. You had DEC for shoes. You had Netflix. You had ANET. And all these stocks, like if you looked at DEC, October 27th was the market bottom. DEC put in its earnings that night, and it gapped up big on the night the market put in its bottom. Then the market floated higher the 28th, 29th, and 30th, I believe, if I'm not mistaken, or in that order. And then the very next day was October 1st. The market puts in a big volume day. And at this point, DEC had just had an earnings gap up and went sideways. The day before the market had a follow through, it had ANET hitting 52-week highs. It had Uber basically hitting 52-week highs at the time. Or it was, coming out of, it was like kind of rounding out its side, and it went from 40 to 80. And so a lot of these stocks, they're at 52-week highs when the market goes through a 10% correction.
Yeah.
They are screwed. Like I remember Netflix reported middle of October, and the market still has to come lower for 2 more weeks. And Netflix gaps up on earnings. And if you looked at Netflix, and I'll pull it up right now, it's a great example. right? If you looked at Netflix, the market's going lower, and this is what the market's causing Netflix to do. But Netflix on 10/19 has this big gap up for earnings, right back up above the 50, the 200. And mind you, the market still has to go lower until the 31st. So while the market's going lower, Netflix literally goes sideways.
Yeah.
Literally goes sideways. And it was a big gap up on earnings. And now the market's getting beaten up. And this thing is no longer getting beaten up because institutions are not selling it and they're buying it even when the market's going down. Hence the reason Netflix is going sideways.
So if I've understood like this conversation correctly, this is a test for me.
Yep.
So what you would have done then in that Netflix example, as per your setup, obviously it's gapped up, it's gone sideways. Then you get in the strength from the market.
The follow through day. 11/1 was the day. If you have, so, and I've studied this, and I would recommend any swing trader to study Mark Minervini. He is probably the best, in my opinion, or one of the. It's something called progressive exposure, right? If I don't have a swing portfolio, I don't just go from no exposure to on margin in day one. That's not how that works, right? If I have no exposure on it because the market's just coming down, all of a sudden, Netflix gets on my radar when it gaps up on earnings. All of a sudden, DEC gets on my radar when it gaps up on earnings. But what I'm really waiting for is I'm waiting for a market follow-through day. So the way any market follow-through day in the history of follow-through days, as described by Bill O'Neill, is you get a bottom. You don't know that it's the bottom, but it's a bottom, right? Usually it can be big volume, but there it is. So then what the market will do is for a few days, 2-3 days, it'll just climb higher, right? It'll like float higher. And then the 3rd through the 5th day, you'll get a nice, healthy green day in the market, but on an increase in volume over prior day, right? So now this isn't just some low volume bounce, right? It's a 3-day move up, but then on the 4th or the 5th day, and now all of a sudden institutions are interested, and you get this pickup in volume in the Qs and the ES. Now all of a sudden you don't even have to buy at the open. You can wait until the ES is about to close, like a market on close order, and say to yourself, okay, there was a pickup in volume today on the QQQ and the SPY, and we're 3 or 4 days removed off the bottom. And to confirm to yourself a little bit more that you have reached a bottom, or you're more likely that the market's at a bottom, how many sectors and stocks are actually set up to go higher? Because it's stocks that drive indices higher, not indices that drive stocks higher. So what stocks are set up to take the markets higher? Back in October, your leading group was cybersecurity, without a doubt, right? And so cybersecurity was set up and ready to take the market higher, and it did. Mega caps were also set up to take the market higher. Anything to do with data centers. So like ANET was one, VRT was another, and they were like already doing well when the market was going down for that 10% move. And then once we got into November, I've said it before, it didn't matter if you bought a shoe company. It didn't matter if you bought a semiconductor. It didn't matter if you bought Uber. It didn't matter what you bought back on that day, so long as you recognize it was a follow-through day and you've got some rules for how to get yourself in. So like if I see a follow-through day and I've got no exposure, I'm trying to get myself to like 30 to 40% exposure on day one, right? So like that day, AMD has really good earnings. It like flushes out and then gets caught like a bid that in after hours. And then the next day when the market's giving a follow-through day, AMD just puts in this ridiculous candle, right? And you would be like, I don't want to buy at the very top of that ridiculous candle. Even if you did, which was like, I think 110 or 111 bucks, it still goes to 225 from there.
Yeah.
So, and it didn't matter if you bought, and again, this is why I say level 2 doesn't matter. If you're listening to the market well and you're saying, the market just gave me a follow-through day, what stocks are reacting well, most importantly, to earnings? Because if it's reacting well to earnings, right, usually that move can last multiple quarters. We just looked at Abercrombie, right? It gaps up the first time at 26, the next time it's in the 40s, and the thing, doesn't even close below the 50 until 120. So it gives you a couple of entries, but we're always trying to take advantage of these names, in particular when the market is giving us an accumulation day or a follow-through day, And then that's the day that I want to be buying things that are nice and tight, things near 52-week highs. But when the market gets very extended, if I've got like 6 or 7 or like 8 longs open the way I do right now, let's just say the market rips for 4 or 5 more days, and I've now pieced myself out of some of my longs. I don't just want to watch myself get stopped out of the rest of my longs. I want to proactively start to look for weakness. And I want to say to myself, hey, now that the market's ripped higher for the last month and a half, right? What names are showing relative weakness? And then when the market gives me some distribution, what are the names that I'm ready to short, right? And then that way, if the market does begin to turn lower, I can already start to use the same way I would get long and use progressive exposure to get long and initiate my buying power onto the long side. You get the follow through day, you buy 2-3 names, you get 30-40% of your money at work on the long side. Once the market gets stretched to the upside, I want to start to say to myself, how do I get 10, 15, 20% of my money to work on the short side, on the swing side? And the same thing can be true. Like last year, I was swinging IONQ all the way from 20 all the way down to the low teens, right? And again, it's a very simple setup that I've studied. I learned it from another very talented trader, but called a double top short sale setup. But I've even heard Nate, who I've got tons of respect for, just says look left, right? Yeah. IONQ literally hit the left side peak around $20, and then got destroyed, right? And so. But the key is, right, and then I shorted it as a double top kind of a setup.
I've actually got that T-shirt on. Actually,
always look back.
It's not mirrored, sorry, at the moment. But
it was funny because I actually, again, if I'm just sitting here, I hate to say it, sometimes I just take a little scalp if it's staring at me in the face. But today I was like watching APLD because I dislike the name, and it hits the left side peak at like 720, and I have like a 719 average perfectly. And I catch a move all the way back down to VWAP for like 35, 40 cents. Nothing crazy, but wallet pattern while I'm still sitting here allowing my swings to work, right? But again, the thing with day trading, it could be very, very dangerous, is position sizing. You want to make money, so you oversize something, and then you oversize it. And if you're wrong, now you're chasing back gains. And I've been there, so I don't do it.
Yeah. Well, I mean, I think after this hour, I think everyone's going to want to shift from day trading to swing trading. One thing is, look, so clear and obvious, though, is like it must be your commitment and dedication to the market. Like just the way you're like recalling dates from 10 months ago, the way that you're calling names, you're describing almost, honestly, from this conversation, I almost get the feeling actually that you could just like close your eyes and draw charts over the past like 3 or 4 years. Just that level of like detail and knowledge. Like
I could, which is very sick.
I mean, it's commitment to the craft, I think. And just like to wrap up this, like it's honestly one of the most fascinating conversations I've ever had. And like it's just, and it's also like so inspirational as well. Like just that level of detail, how like far you've explored it, but also like it also sounds like actually you've made it like as simple as possible for yourself as well. Like you start recognizing those patterns, and it's like a simple, I say simple, it's like, okay, I take this break of this level, and then I got my criteria for my exits, and then you've almost obviously got the same in reverse as well.
Mm-hmm.
I'd just like to wrap it up. So someone like, you got someone here watching now, they've never even swung a trade, let's say, let's get real basic. What would you like, just like perhaps the next 3 or 4 steps in the coming weeks, months to start that path to get to, to get somewhere near to close to your level as possible?
I think the most important thing, the most undermentioned thing is learning to scan the market. And even as a day trader, you know how important it is to find the needle in the haystack, right? And I just want to know, where are institutions putting money to work and where are they taking money out of, right? And I rely on those moving averages to simply say, is this thing in an uptrend or a downtrend? And if it's in an uptrend, how do I hop on that train, right? And the train through consolidation is the only time it stops at the station. Right. And so I think if you're a brand new trader, it's super important to learn to scan the market and focus on leading groups. Even FinViz has tons of great resources for figuring out over the last 30 days, over the last 90 days, 6 months, what are the leading groups, and focus your energy on leading groups. If you like, half of a stock's price appreciation is directly linked, one, to its earnings and sales, but more importantly, to the health of its group. Half of a stock's price appreciation, right, is directly linked, right? AEHR doesn't ever go to 50 if NVIDIA doesn't take off from 160 to 400, 500, right? It went 5x, and that allowed AEHR to go from 20 or 15 to 50, right? And so a stock's price appreciation is directly linked to its group. So it's very important, if you're a new trader, learn to scan the market, figure out mentally, or right on FinViz, over the last 30 days, where's money going? And then secondly, learn what is extended, what is not, right? Learn to refrain from having FOMO, because there's always tomorrow. The stock market is not closing, right? It's never going to close, right? Nancy Pelosi will not have this game turned off. And so,
She certainly won't.
yeah, they will not turn this game off. Trust me. And so exercising, really good discipline, because there's always tomorrow. So learning to scan the market, understand what a decent setup looks like, and then, almost think contrarian, right? I'm not looking at the stock and saying this stock has gotten too cheap. I'm saying to myself, okay, the market has now pulled back. What are the names holding up best? Yeah. Right? Or the flip side of that is, this market has just gotten way too crazy to the upside. What are the names showing the most weakness? And then always think inverse. If you're going to short, those are the ones that have been showing most weakness while the market is strong are the ones you want to short. And inversely, if you want to be long, what are the names that have shown most strength when the market is weak? And those are the names you want to be long, and you want to buy them, or you want to engage in any of your positions when the market direction is at your back. If I want to short one of those weak names, I want to do it when the market's coming down. If I want to long NVIDIA today, I want to do it when the market and its friends are going higher, right? What's Apple doing? What's Microsoft doing? What's Google doing? What's Tesla doing? Once those are the market is doing well, what are the other semis doing in its group? Because I understand NVIDIA is the leader, so they're all going to kind of go behind what NVIDIA is doing. So what are a few clues that the market can give me that NVIDIA is good to buy, right? Okay, so what's the NASDAQ overall doing? Give me a bigger picture of what the market's doing, okay? The NASDAQ's not getting beaten up right here, right now. NVIDIA's turning back up through yesterday's highs. It's starting to break through the range. Let's buy it. And I think that just becomes key. And then finally, for probably new traders, is position sizing. I cannot overstate this enough. I've done this to myself. If you oversize something, it just leads you to get shaken out of every little single ebb and flow. And don't worry about being early to something. Just because you think you know something that the market doesn't, if it's not being proven through price, being early is still being wrong. I learned this the incredibly hard way in CCJ. I bought it at the end of 22, and I caught like a $5 gap down overnight, and it cost me $250,000. So still to this day, it's probably a top 10 loser of mine. At the time, it was the biggest loser I'd ever had. But had I held that position, right, it would be over a 7-figure winner. But because I was early, I was wrong. And being early is being wrong. And I didn't know that $5 gap down doesn't then turn on to a $10 move and a $500,000 loss that I really couldn't have afforded to lose. And mentally, that would have just destroyed me. But I cut the loss. I learned from it. Being early is still being wrong. And I want to focus on things going up, getting tight. That's how we limit risk. That's the train stopping at the station. And I want to buy it as the train is departing the station. But I want to know that many other trains are also departing the station. And that we were going to know through scanning. And that's why scanning is so important. Like I said, not level 2, not none of that crap. Because had you bought on November 1st, you could have bought, like I said, a shoe company, could have bought a semiconductor, you could have bought a data center name, you could have bought Netflix and chill, you could have bought so many different sectors, right? So many different parts of the market, but because the market was no longer going down, you're not fighting the major trend of the market. and you had waited till the market had given you a follow-through day. And I implore everybody, right? Study. You can go back and study what the SPY and the Qs looked like next to AMD, ANET, Netflix, Uber, right? And just even though, and DEC, right? Those 4 or 5 names, and look at how they acted going into that follow-through day for November 1st and see how they acted. And again, most recently, when the market had that big washout bottom and things started to turn up, right? You had all of these energy names turn right back up. Your VST, your CEG, your GEV, they were already hanging out near highs, even though they got beat up just like the rest. But similarly, home builders, right? Hanging out right near all-time highs when the market started to bottom. It had that big washout, and home builders are. So if home builders aren't going down when the market's getting crushed, what are they going to do when the market starts to go back up? So it just becomes can I time them because I can find a tight entry? And also, am I sized into them properly so I can hang on to the full trend? And then finally, are you playing something proper for the size of your portfolio? If you've got a $50,000 account and you want to play, Google and KB Homes and Toll Brothers, you're going to drive yourself crazy with how slow they are. Your portfolio is never going to grow. So when you have a smaller portfolio, you have to play things that are a little bit faster. You have to catch that wolf that goes from, or iron, or, wolf that goes from 2 to 4 or whatever the hell it went to. It doubled from 4 to 8 or whatever it was. I think it was 4 to 8. And that's kind of what you need to catch if you have a smaller portfolio. Once you get a bigger portfolio, it's liquidity, and position sizing and patience and moving averages and just timing your buys with the market and never looking at a stock below moving averages and saying it's gotten too cheap. You have no clue, right? And all you have to do is look at Sedge to realize you have no clue. For the record, I had a $313 short on Sedge with 3,000 shares, and I choked it. I covered it for a loss.
Wow. At least, at least you're admitting you make mistakes. I love that.
Oh, dude, it's terrible. I even I had 3,500 shares of Lilly at I want to say it was $311 if I'm not mistaken. I'll tell you right now exactly where I had Lilly. Oh man, this one just kills me to look at. Okay, I had Lilly. $311. So I thought this was really tight right in here. And I was buying it just as it was getting back over the 50-day. The very next day, I caught a gap up. And it was literally a 6-figure gap up. So I sold the entire thing. I felt like a genius, because it came back the next day and then it just grinded higher. And in here, I felt like a dummy. When it pulled back, I was like, and by the way, part of the thing was it was like too slow and too choppy in here. And this was part of the reason that I left it alone. I was just like, it's too choppy. I don't want to deal with it anymore. And obviously, hindsight's 2020 when you own it way down here, and now it's tripled from where you owned it. And I could go on and on with the thousands of stocks that have done that to me. So it doesn't really matter. But I think the important part is don't be early. Don't get crazy on your position sizing. Learn to scan the market. If you're a new trader, you have to be super patient with yourself. I make so many mistakes still. I want to say my hit rate's probably like 30%. But the thing is the winners that I do end up having, I could have 30 losses, 40 losses in a row because of the one win that I had on NVDA earlier this year. Yeah. Right. I've had some good shorts as well. I don't really count them like great trades. Like I had a short on Mara the day the Bitcoin ETF got approved and Mara got absolutely destroyed. SMCI, I had a nice short on it, but the problem was I gave back half my gains twice on it, and that hurt really bad. So I kind of just left it alone after that because I gave back half the gains twice, and I was like, I thought I nailed it. And sure enough, like the nailed it didn't really happen until 800. It's when it, started to like break down for real. And at that point, you're just like, I don't want to get it. So there's always another trade. And I think, it's really important for traders to recognize that. Be super patient with yourself to get highly proficient at scanning the market, maybe like myself or, guys like Yossi Koulibaly or like a guy like I gave mad respect to, Minervini, just being patient with yourself in scanning the market. You have to try and figure out where's money going, where's money leaving. And I'm always trying to buy things with the market direction at my back, whether I'm longing or shorting. And I'm happy to be doing both at the same time, right? I've got a bunch of longs open. And today I thought was going to be a nice mean reversion trade on Palantir. It was, but of course it just faded too much right off the open. And I never could, how do you deal with that? I gotta flip this on you. How do you deal with that? How do you add more size? Like, what do you?
Well, the person to look at. So Nate traded Palantir really well today.
Did he?
He did, yeah, like really well. Like and I mean, like his style is really set up to like capture those days, like when you've got a clear trend. Like he just doesn't hold back, and he's not always waiting for a bounce because he knows. I guess it's tough because you just know the best ones aren't going to bounce. So, I mean, it's I'm not going to say it's easy or anything like that, but
no, because it was killer.
Reference point.
I saw that little push into the 38s, and I wanted to risk off yesterday's highs right into pre-market. I was hoping that would happen at market open, and then right at market open, I'm watching the tape, and this thing is violent. I mean, it traded 5 million shares in the first 5-minute candle, and I'm like, what the hell? I felt like I was chasing it that entire 5-minute candle down, and it was fine. It's still a fine trade, but yeah, I understand where when it's finally gotten extended on that daily, and just that the day is just going to be a full, just one day unwind, or one day and maybe tomorrow, and then one little quick morning washout, you'd be looking to cover or something. But yeah, that one's so tough, man. I always struggle because I prefer is if something like that opens, it gives you a little morning washout, comes back and retest that pre-market level during the day, I don't know, 30 minutes into the open, and then gives you that flush after, 30 minutes or 1 hour into the open. Just gives you that fake little ramp for 30 and then unwinds. But of course it didn't. It just unwound very hard.
And I always think that there's always those occasions where I'm undersized and I'm like, I'll just wait for it to pop. And I just need to remind myself whenever that's my mentality, the pop's just probably not happening. It's like it's like I'm still having to work on it all the time.
The pop happens when you shorted it with plenty.
Yeah, exactly. But then on that note, I think it's almost like the psychology of everyone then has got the size they want. So it's going to pop. Whereas you have obviously the exact opposite. No one's been able to get short. Yeah. No one's been able to sell it. All of a sudden you get that violent candle. Yeah. And then it doesn't pop. And then all of a sudden everyone's just got to panic out on the bids. And then that's when, it's so easy. And hindsight's 2020. I love that.
2020. And that's how I felt today. I took another one in. So I played the Kurzweil short report on Lumen really, really well. The day that it was dropped, I was already in from the day before, and then the day, somehow they show up on the day that, I'm already short from the day before and drop that.
That's when that happens.
And so that was super nice. And I remember I saw Nate mention it on Twitter too, because it had the washout all the way sub 5. And I've tried 2 other times to short it on the pop, and it just has stopped me out every single time. And today I reshorted it again. And a friend of mine, he shorted it as well, and he's just like, I'm going to add some more on the V-shaped recovery. I said, dude, this thing has grinded all the way back from $4.50 all the way back to $7.50. I said, shorts are done with this thing. Mentally, they're probably so fatigued. I'm so fatigued of this thing. Everybody's got to be fatigued of this thing. I said, these are the ones that don't bounce. Yeah. Right. I was like, it grinded every time you thought it was going to come down and have 2-3 days in a row. It would have that one red day, and then the next day it's a green day, and then it's higher the next day, and then you'd short it first red day again, and then it one day down and then back up higher. And it's very frustrating. I think it probably frustrated everybody for about the last 2.5 weeks. Today you get this move up to 750, and I started shorting as I was coming back through VWAP 740s. And my friend was like, I want to add some on the pop. And I was like, see, you say that because you've now seen it pop every single time for the last 3 weeks. I said, one of these times it's not going to pop, and you're not going to have the size you want on it. I was like, so that is the beauty of trading. It becomes a real catch-22. But again, when you're swing trading, I always tell myself, 10% of my portfolio, if it's a small cap, sometimes 5%, because it's just hard to buy a $4.
Yeah, I think that's another key lesson as well. Like, because I think like you said, like the Lily example, you do have to ride a bit of a storm. And I think if you suddenly see like record P&L go from like whatever to nothing to back to record to nothing,
very emotional.
That's exhausting. I mean, it's exhausting just saying it, to be honest. Like I'd be like, whoa. Every time I'd be like, oh, record 0, oh, scratch out. And then it goes to and then I don't know. I'd be all over the place, to be honest, if I was.
I think that's why having only 10 or 15% of your portfolio in something is so important. Because hypothetical, if you have this $1 million account and you put $100,000 into NVIDIA when it broke out at 500, right? I mean, there's not you can't even really buy many shares, 200 shares. Right at 200, maybe because it's NVIDIA and it's the market leader, maybe you get yourself to 20%, and maybe you have 400 shares, right, of this stock, right? It's like, even if it moves $100 from 5 to 6 to 7, I mean, even if it goes $200, 80,000 to $1 million account, it's not the most insane amount of money, right? I know guys who day trade with $1 million and make 80,000. That's in a day or two, right? So, making 80, but being able to sit in a 200-point move, right? Being able to then say, I own NVIDIA, and it's well above the 50-day moving average, right? This company has, and by the way, the key here is institutions move stocks, right? They want to get paid too. These things have to move, right? They have to move for a while, and they build positions for a while. And I've never caught like a ANF going from 35 to 200, but I'd like to, right? I once owned, I told you, NVIDIA at 167, and I sold it at 230. I thought that it moved too much, and then to see it where it's at now, it's basically where I bought it, but a times 10 split. And at the time I had 3,000 shares. Part of me goes, man, had I just pyramided into it, right? Had you just bought your 3,000, and then it had another flat base at 243, I remember it perfectly. And then it had another setup at 500, and then it had another setup recently. It's like you pyramid into something like that, and it never breaks below the 200, and it's the market leader. That's how you end up in it. 10, 15.
I remember Maggie talking about that, when you get like setups on top of setups, and then you're already in, you've had no reason to exit. And then you get another setup, and then
buy more. Hey, just buy more because this new setup still has a low of day stop, below low of day.
Yeah, the risk is still tight. Yeah,
right. Your risk on the new shares is so tight. And here's the thing: like, you could treat it as a whole brand new setup and buy a whole new lot of shares, or you can size down a little bit because you already know you own some from lower. But honestly, if it sets up again cleanly, you could buy the whole thing again as a whole new position because your other shares are still being trailed on the 50. But now the stock's gotten really tight on the 10, 20, 50 again. And, maybe you're not even using the 50 anymore because it's gotten so tight. You're using like a lower pivot on the daily, which is still well below, like it would have to break the 50 and almost go down to the 200 just to get down to that pivot.
Yeah.
And part of you goes, I'm still holding it from there, so it doesn't even matter. And that is the beauty of swing trading. And I've been in a swing trade where it's been lasted over a year, and the benefits on the tax side are also really nice too, which can't be understated. Some people may not think it's a big deal, but once you do start swinging with bigger money, it certainly it is a big deal. So, and I've only ever held the name for a year, and hopefully many more to come. But I think it's more so market environment than it is the individual name. If you're in a roaring bull market, like I said, you're not like if you started around my time, 2020 and 2021, dude, I used to like literally do nothing to make money. I used to just trade sympathy plays. GME was going, I'd buy AMC or EXPR or COS, right? When TCAT was going, I was just hammering away on DLPN. When Mosey was going, I was just hammering away on WISA or LEDS, right? And it was just the exact same. And the psychology was in 2020.
I'm just smiling at your recall. Like I haven't heard TCAT and DPLN. I remember trading those, but I haven't I don't remember anyone mentioning those in quite some time.
Well, that's and honestly, sympathy plays was the easiest way. Like I remember my first six-figure trade was Sun W, and it was the day that SPI went from $1 to 46. And if you were there for SPI that day, you were like, "What the hell just happened?" But
we're actually it happened around this time.
Yep, and so
the 23rd of September, I think.
SPI happens, and I remember I'm on FinViz, and I'm like, okay, SPI, okay, solar, all right. They started like at about $1, and so I found Sun W, and all of a sudden I'm seeing that there's there's like some steady little bit of buying in here, but it was like at 83 cents when I noticed it. And by the time I was done filling in, like I had a $1 average, and same intraday, it went to $4. And so, yes, it wasn't a 4,600% move like SPI, but it was a very, very predictable upcoming move. And it was the same thing like with, and this is actually why I got, kicked off of Thinkorswim initially, is because I was doing such massive market orders. I remember when AMC was running, I was just market ordering, costs as much as I could. And, some guys know this, some guys don't, but like there are certain brokerages, they offer what's called midpoint fills. And so I was getting like these market orders right between the bid and the ask, but the ask isn't moving. So I'm just like literally getting filled 2,000 shares at a time on cost, 2,000. All of a sudden I'm like 25, 30,000 shares in. And then all of a sudden I'm like, all right, AMC still flying. And now I'm like, all right, I'm now willing to buy costs up higher. So now I'm hitting the ask, and prices are now starting to move, and people start filling in the bid. People start filling in the bid side, and I'm like already slamming out. But you're getting like these 50, 70, $1 moves, in a minute, 2 minutes, and I'm 30,000 shares in, and all of a sudden, like 60 seconds, I'm making 25, 30,000. Then the thing would flush out because you got a bunch of market sells, and AMC's getting wicked right back up. And so you're marketing right back in, or you're limiting right back in. And it was such a shit show, 2020 and 2021. Like it really involved no true skill, where once 2022 happened and I transitioned to swing trading and small caps were really dead. Obviously IWM got absolutely pulverized. Small caps, went to hell. That's when Carvana's, spent the year downtrending plus. And, that's when your Sun W's went from, they broke out and they became great charts. And Sun W at one point was at $28. That'll tell you. And it came all the way back, and they don't even trade anymore, if I'm not mistaken. So that just goes to show you how far we've really come within the market cycle. But that's really like the market. You have to focus in on leading groups. And if you do that, leading groups, leading sectors, good earnings and sales, charts that are super tight, not extended from the 50. And if there's one piece of advice that I would reiterate, it's take a percent from the 50-day SMA and draw it up to current price where it's nice and tight. And if a stock moves 3% per day, but it's more than 12% above the 50, it's 4 times its average true range above the 50, think twice about buying something like that. You look at something like NVIDIA today where it's only 1%, literally 0.86% at yesterday's close from the 50, right? If you're wrong, you're risking a close of that 50, 1%.
I must admit, I do love the system that you've come up with in terms of, and like I said before, like I can see the experience, the passion, that everything's gone into it, but actually how you're able to, it's not that difficult though to talk to me about it. And I think that's what's great. And I'm sure that's like encouraging for everyone, is that like you've made that transition from, trading those names in 20 and 21. And then now, it's, sounds like you've had some insane trades. And I think that's again with like swing trading, like, with Short Bear talking about
SMCI.
Yeah, and selling him some of his, he tweeted that he sold some of his portfolio today. And it's like,
it's because he's selling into, what did we talk about when I mentioned Baba? Right? It's like you look at Baba, and again, smartly so. That's not to say that it cannot go higher. And I'm sure the Short Bear doesn't think that his positions cannot go higher. Otherwise, he would have sold it all. But when you look at price compared to the 50-day, it's almost the most extended we've been in like a year, right? But just from its own perspective, where it's currently at to the 50-day, it's very far away, right? Like NVIDIA, again, 4% from its 50-day, BABA 20% away from its 50-day, right? NVIDIA is still tight to its 50-day, BABA not so much. So the short bear selling some into strength is the right thing to do. And then I've seen him do the exact opposite when everybody's very fearful. He's looking for, maybe undercut and rally setups. He's looking for a red to green move. He's looking for something to help initiate his position. So he's just not staring at big red right off the start. He's trying to build. And one of the things too, with like pyramiding or even when you're day trading, I would much rather average up than I would average down. Average down means you're wrong and you're adding while you're wrong. Averaging up means you're seeing it well and you're adding to your winner, so that even if you end up being wrong, and it could still end up being a flat trade. But if you're wrong already on your initials and then you add a little bit more because they're just your initials and your starter, and then you add a little bit more, but you're still wrong, and then your second adds don't start to turn up right away, adding a third and a fourth time lower and lower effectively leaves it impossible for you to just get back to break even. Yeah, completely. So, and that's exactly the same like with day trading. Like it's you just all you do is end up with an oversized position, and you're just trying to get back to break even. Yeah, you're relieved actually if you get back. Like it's almost like a relief actually if you get back to break even. And just the opposite is what happens when you're oversizing a position that's already working for you. You're only beaten up if it comes back to your average and you take a flat trade because you were just looking at an absolute monster. Well, you put yourself in a position for that monster. Yeah. For an emotional beat up, but not a financial one. Yeah. Try to get one of the two, not both. Yeah, you get none, obviously, but like if you're gonna have one, maybe the emotional might be better than the financial. I look at it at the end of the day, and when I was day trading, if I was at zero, it wasn't a big deal. Like if you made no money, it wasn't a big deal. Yeah, but if you had to like even be down, $3,000, $5,000, $10,000, whatever it was, like that sucked, right? Like it sucked, and I would rather just give back 10,000, like and go to zero than to like literally be red 10K. Like nobody actually wants to lose 10K, but I'm happy to give back the 10K that I was up. Like you don't want to do it too many times. You want to figure out a system in which you're locking in some kind of gain when you have some gains like that. But the reality is, if you've got 10,000 in open gains, you shouldn't have just gotten that right off of your first button click. I probably would have pyramided myself into a position where you've now added and you were right, you've added some more and you were proven right, and you added some more and you're more right again, and you're averaging up into a winner versus averaging down into a loser. I've never ever done well averaging down into a loser because you're not reading the market right. If it's going down, it's because institutions aren't buying it, point blank, period, unless you're playing small caps. But if you're playing like companies that make money and in a real theme, like semiconductor or AI data center or, this energy, the CEGs and the GVs, if they're going down, it's because institutions aren't buying them. But if it's going up and you're just continuously adding to something that's working, you're seeing it well. You're on the side of what the big boys are doing. So, I think that's the key. I think, to be honest, like this conversation, like it's like a light bulb has, like with your help, obviously, like a light bulb has like a switch is flicked. Like it does. It's just started actually to make so much more sense. And I can only thank you. I only thank you for that. And like you said, like being on the right side of institutions, like things like that, like it just begins to make sense. Okay, like what would they be doing? Right. Okay. Well, then if they think it's going higher, they're obviously not going to be selling. They're not scalping the move out today, right? And you could look at Tesla like 2 days ago. So this would have been on Friday. Tesla, I bought it over $234, had a nice little pivot, 234, and then Monday, yesterday, it flushes and it kind of gets close to my average, but it doesn't get close. It doesn't get close enough, or it gets close enough to low a day. But then what does it do today? It turns right back around and it's out towards new highs. And so I think, or excuse me, this would have been Thursday, it took off. Friday, it pulled back. Monday, and then today, it had 2 good days. So Friday last week, if you had maybe oversized too much, or You get a little too impatient, you're not using your moving averages, or you're not using your proper stop, then you shake yourself out of Tesla. And I know guys who did, right? They bought it with me on Thursday. We're in the Discord, and then on Friday they're like, I stopped out of Tesla. I was like, why? Like, draw a horizontal line. Price never even got back to that horizontal line, which I know is the place that a lot of people like to buy. And the psychology is very simple, right? If you have an area of resistance that breaks and you have short sellers at that area of resistance, once it retraces back to that level, shorts are like, well, I just got blessed. Let me get out for break even. And then that's what ends up happening. So,
cool. No, I know it does make so much more sense. And thank you.
We could probably go on for days.
I was going to say, like, I mean, I'm only stopping because it's 1 a.m. here.
Quick last little quick comment, and this is true. Like we were talking about initiating a position when whatever side of the position you're taking, momentum's on your side. It's like when you short, how much easier of a time do you have it when you short a red candle and then you're instantly green versus trying to short into that move higher that like you're like, okay, is it going to reject yesterday's highs? Is it going to? And like you're like, all right, I'm going to get in just a couple cents before because I still think it can go higher, but let me get in a couple cents before. I've done that too. And it's like, and you end up being right. It ends up going to yesterday's high to reject, but you got yourself in a few cents lower, just kind of anticipating that rejection. But you're staring at red first versus like.
Yeah. And I always think like, if you think of like when Lance talks about the right side of the V, like by definition, like if you want to be on the right side of the V, like you typically should be buying probably a red candle. And conversely, if you're selling, I mean, obviously there's going to be like pullbacks within that, but like if anything other than that, you are always think like if something's going higher, and you're looking to get short, you're just not going to be right because it's just going against you. So
yeah, it's like, and so I would almost rather short the red candle, right? Then and same thing's true with the daily, right? Like I don't want to short something as it's a green candle on the daily. I'd rather wait for the first red day, right? Yeah. Or I don't want to short something on the first green day in which it's breaking out of something, of some consolidation.
And I think that's what's powerful though about the system that you've talked about tonight is that like take SMCI for example, like it's very easy. Like what did it top at? It went to like what
1200 and change, and my best average was a 1076 on it.
Yeah,
but I had a bunch of shares, dude. At one point, it was a humongous position.
But you think like there's like a lot of these. What you're talking about though is that like there's like opportunities again, and the same like Nvidia. Like take buying Nvidia today, like you could easily think, oh, I missed the buy at 100, say, and it's like $20 away now. I can't do it. But then when you start talking about actually, it's just above. It's a % above the 50-day moving like average.
It's super tight. So
it's tight. Yeah, exactly.
Yesterday's lows, you're risking 2.86%. We're literally talking about peanuts here. Even if you had 100%, even if you had 50% of your portfolio in there, which you should never do into any one stock, but if you did, right, even if you 100% into NVIDIA, first of all, it'd be the stock to do it with, but you'd have less than 3% risk on the whole thing. Like if you had $1 million and you put it all in NVIDIA, you'd be risking less than 30K. What? For the potential for it to go 40, 50, 60, 70, $80.
Yeah.
Right? It's like, so that's the thing. And the thing here is we don't have all our money on NVIDIA. So if it's going to ebb and flow, if it's going to chop around, if it's going to do this and that, it doesn't matter. Right? I understand if you want to get up to 20% of your portfolio in NVIDIA because it moves a little bit slower. I get that, right? If something's too slow, you got to allocate a little bit more money. If something's really fast, you don't need as much money, right? Like if something moves 20% a day, like, and something's going to go from, $4 to $5, right? You don't need, 10% of a million. You don't need $100,000 in there to do really well.
Yeah, makes sense.
Right. So I think that's the key is position sizing is so important. It helps you stay in that trade. And then, scanning. I mean, we talked about it. If you don't understand where institutions are putting money and where they're taking it out of, but the beauty is when you are just looking at daily and hourly candlesticks, they take a long time to finish and develop. Everybody thinks that you have to be in some rut. Like when you're day trading, fighting for your average matters because you're putting on big size, and every 10 cents matters when you've got 10,000 shares, right? But when you've only got 1,000 shares, you don't care about those 10 cents, right? You just want to know that you've got the trend in your favor, the direction, the bigger trend in your favor. And if it's not, then your stop is really small because you're looking at tight daily candlesticks. It's like even like APP, it gave a perfect setup, and then the thing went 40% in like a week. And I mean, anybody who understands a good set, and this is probably the one that I would be kicking myself the most, right? If you bought this thing, on 9/11, right? And you look at app, right? You had a big move up, you had a big move sideways. Here was a good entry for earnings, right? So you had this 215 earnings gap up, or again, right in here. Look at how absolutely tight it got in here. Right? It had a washout, held the 50, then you had an inside day and another inside day. So you're basically saying to yourself, anything over, 88.30, you're long, basically. And here's your entry on 9/11, and this thing basically goes from 88 to $130. I mean, that is just absolutely absurd, right? And that is the power of what swing trading can do. Instead of every single day looking for an entry, every single day trying to come up with a clever idea of how to make money, get a strong chart that's already been in an uptrend, let it build a base, let it consolidate, let it be in the right sector. You look at APP and you say to yourself, oh, well, what sector is APP? And AppLovin software. And then you can start to say to yourself, well, what other stocks are in the software sector? If I'm not mistaken, Now's a software name, Palantir's a software name. And what's Palantir been doing? What's Now been doing? Oh, these names have been making new highs, new 52-week highs at that. So you don't really even have to think too hard. And then all of a sudden, day one, this thing goes from 88 to 96. It's up 10% in a day, 10% plus. You're in the driver's seat. By the time you get up 20%, sell half the position, let the rest work. Now this thing's up like, 45% in 2 weeks.
And like you said it there, and I think that's, to be honest, that's a perfect note to end it on. Like, that is the power of swing trading in terms of this. And I always think with names like this as well, you aren't at risk of an offering overnight or
nope.
a 50% haircut or whatever it is that you.
It's not some biotech with PDUFA dates. It's not some name that's about to do some convertible debt offering. It's not some stock that is a $4 stock to begin with. Right? It's not, it's a $80 stock. It's been in an uptrend for the last year. It's in one of the best groups in the market. It's at 52-week highs while the market has just been undergoing an ugly correction. I mean, it damn near had everything going for it. Had 2 double inside days. I mean,
ticking boxes.
You really couldn't limit your risk upon your entry any tighter. It's literally a double inside day. You buy it over the prior day's high and your stop is the low of the day or even the low of the prior day. As long as you're sized properly and you know what the low of the prior day is, size into it right. And all of a sudden, you might be out of half your position. And everybody's, and I know people and myself too, I used to say to myself, oh, I one time bought the name at 80. I don't want to buy it again at, or I one time bought the name at 50. I don't want to buy it again at 80. Because I did. I once owned app in the 50s. Right. And then, I eventually got stopped out of it, and then it reset up again at 88. And some people will say, oh, I used to own it in the 50s. I don't want to buy it anymore. It's gotten too expensive. Too expensive or too cheap are like famous last words of people who have no idea what they're doing. Right. Look for tight. Tight is how you limit risk. If it's in a top 40 group, it's in a top 40 group because institutions have bought those names so that they can be in top 40 groups.
Yeah.
So if they're in top 40 groups, means they're being bought by institutions, right? They're not solar names, right? They're far from top 40. It's like group number 197, right? So that's literally the last group you want to own. But anything in the top 40, anything that's tight, anything that's already in an uptrend, anything that is at the train station, right? I don't want to hop on the train up here. Like everybody's like, oh my God, I missed app. And they're trying to look at app to buy it, right? And I'm looking at app this is going to make a good short soon, right? So it's like the mentality is totally different. I'm all about a long when things are tight, and when things start to get a little ridiculous like this, I start to think the other side. If I'm not already long, if I'm already long, and you're trimmed, you're sitting there saying to yourself, hey, $108 is my current stop, which is the 20-day. And if you're in at 88 and you got a $20 cushion on it and you've trimmed, who cares? So, and that really is the power of swing trading. And there's been so many great examples like APP, right? We just talked about GEV. It had a really nice setup, and that's up a ton. CEG, same group. And you look at VST, same group, and look at all of them. They're all out to new all-time highs. And so it's very important that you focus on the group, and then things that are tight, good earnings and sales, and then buying things as the market is in your direction. Whether you're short, you want distribution. If you're long, you want a nice follow-through day. And then ideally, you're buying stocks after the market has undergone a correction, right? Not like when the market's up for a month and a half straight. Market's up for a month and a half straight, I could care less about relative strength. Everything should be damn strong if the market's
yeah, good point. Yeah.
But when something starts to be weak and you're scanning, like I noticed Visa, right? I don't necessarily want to trade Visa because it's super slow, but the market's at all-time highs and Visa just had this nasty down day, right? Where it's like this thing just has a one ugly distribution day, has massive volume on whatever day this is, 227, which was, I believe, options expiration and rebalancing. And so you got massive volume on that day. And then you've got this huge gap down and follow through, right? I don't necessarily want to short Visa because it's such a slow name, but I know that Visa, MasterCard, I don't know if it'll start to trickle down into like Affirm, right? But anything to do with like payments or collecting payments, I would assume it's probably hands off for right now until this thing, because this is just too much volatility, right? You have this, you stairs up and elevator down, and now you need that elevator down to find a bid, find some support against rising moving averages, tighten back up. That's not saying that Visa's done going higher, because I guarantee you in 5 years it's probably much higher than it is right now. But if I want to hop on board, I need that volatility to subside a little bit. But right now the trend on a smaller time frame is down. And so I would say to myself, hey, if I wanted to hop aboard a short, I would need it to go sideways. And then because the most recent trend is down, I wait for that sideways. And usually you'll get like rejections on an hourly time frame, or even if it pops back up on the daily, it'll bump into a declining 20 and reject. And then it'll build another little range. And then if it breaks to the downside, you short it. And, that's literally how I play it. What's the most recent move? If recent move is up, then we wait for some sideways to hop aboard. The bigger the base, the better the move. And we could probably go on for all.
I was going to say, you have fully converted me. And this is just.
We'll chat again off of camera, brother.
We'll chat off camera. And then I definitely think we should do, it sounds like in 6 months or so, a part 2 would be good. And I just think there's so many nuggets for like the way you're like talking about names as well, where like you've just given so many nuggets for people to go and back test and be like, okay, what does it need to look like? And things like, like what I want to do now, tight is right. I'm going to write that down like in a sticky and put it on my monitor. Little things like that, like the cues, like for like tight is right. I love it. So, thank you so much for your time. It's been truly enthralling.
And even for yourself. And even for yourself, go back to early 22 and study the setup on all of those energy names, from Oxy to DVN to FANG, like from ExxonMobil to Chevron. Like just go through them name by name and look at the setup leading into January 1st of 22. And then also go back to this latest period in October when the market was undergoing its correction. And then look at those names that showed the best relative strength, right? AMD, ANET, DEC, Uber, right? And just look at those 4 or 5 names and how they acted leading up to and right around the market follow through day of November 1st and the market bottom of October 27th. And just kind of look at those names, look at how they acted, and then also go back to the oil time and look at how all those charts looked. And it could really paint you a good picture of how institutions are literally giving you the exact same chart across multiple names. That's not by surprise, right? Or that's not totally random. And then, the other side of that is, look at what leading groups, cybersecurity or leading stocks do before the market finally bottoms. And then once the market bottoms, how do they act, right? And like I said, it doesn't matter if it's a shoe company or a semiconductor, two totally different parts. One's a technology company, one's a fashion company, but they both go on to double, right? AMD goes on from 100 to 225, and DEC goes from 500 to 1,000. And those are both really great to study. And even Uber doubles. I mean, pretty much anything doubled from October. But if you got too late, side little nugget, if you got too late into because the market bottomed and followed through on November 1st, if you thought, okay, the market's finally in an uptrend mid-December, and you started to buy earnings gap ups mid-December, like ESTC or IoT, guess what? You got stopped out, because now the market's already been going up for 5.5 weeks. And now you think it's time to start buying earnings gap ups? The time to start buying earnings gap ups is immediately after that follow through day, the initial one. But now people wait for confirmation, and the market trends up, market trends higher for a month plus. And then now all of a sudden you start buying these earnings gap ups, and they're failing on you, and they're failing on you, and they're failing on you. And by the way, that would also be your clue that, hey, new positions, I need to start taking my foot off the pedal. The last 2-3 times that I bought an earnings gap up in a healthy market, the market's been coming lower, right? And then it wasn't until January when NVIDIA got a hold and SMCI got a hold that renewed FOMO kind of kicked into the market, right? So November was good. Middle of December got a little tough. It wasn't until the first few weeks of January when NVIDIA took off that, okay, here, wow, look at this massive oversized move. And even at the time, not too long behind it, was the crypto names, right? MSTR and Coin went on big moves too. So, and again, it just goes to show you, it wasn't just Coin alone, right? It was Coin, it was CleanSpark, it was MSTR, it was Iron, it was Wolf, it was Hut, it was Cores, dozens of names. Some have fallen.
What's the saying? The feathers.
The birds of the feather flock together. Birds of the same feather flock together.
Birds of the right, yeah. I'll have to remember that.
Birds of the same feather flock together. So
birds
they're
the same
identical, right? They're identical, and it's the psychology that.
It's perfect. It makes so much sense.
It's the psychology for sympathy plays, right? If you see a bunch of stocks going from, and it's the thing too, right? Argentina's got this guy in there, Malay, and Argentina at first, they've had this huge inflation problem, blah, blah, blah. All of a sudden they get Malay in there, and it doesn't matter what Argentinian stock it is. If you're Argentinian, the stocks have been going up, right? And for a while it was like YPF and GGAL. They weren't even in the same sector, but because they're from the same country, right? They were giving beautiful setups, right? They'd give you the move higher, they'd tighten up, and then they kept going higher and higher. And GGAL doubled. And so, sometimes it's just that recognition. And a lot of times you might be scanning stocks and you might be like, oh, this is a financial name and this is a energy name. Why do they look so similar? Well, it's because they're from the same country and institution.
I mean, we see a lot of that with particularly in where I focus anyway, small caps. With China names, for example, you'll see
it doesn't matter that one is whatever and one is they're just China. And so China.
I don't think the companies do what they say they do anyway. So they're only linked properly. Yeah, exactly. So, and just lastly, then, obviously, like I said, I've absolutely loved this conversation. If people want to ask you questions and something, I guess the best is Twitter. So, what's your Twitter, or is that the best?
Yeah, I'm on Twitter, Real Simple Ariel. And if anybody, I used to be in IU. I've been meaning to make a little comeback because I love the guys in IU. I actually know tons of them. So just to
we'll get that sorted for you.
Yeah, just to chit chat. I would love to just be in IU, but so that would hopefully be a really good place for guys to catch me in the future. Would be in that room. And then if any guys are on Discord. Anybody's welcome to join that Discord. The only thing you have to do is donate to charity, and then you're welcome into that Discord. So, That is like the only that's actually the place that probably most people find me is in Discord. So, but
all right, I'm gonna have to join. So yeah, thank you
brother,
so
you always
much. For
you just gotta shoot me a little message.
Yeah, no, I will do, and I really appreciate your time. And like I said, like this was like 100% the conversation that like I needed, and like I selfishly like was like, I've just got to get you on, and you haven't disappointed at all. I've absolutely loved it, and like I said, it's just I'm gonna have to watch it back, but like it just makes so much more sense. So thank you for your time, and yeah, we got to do this again soon. Thank you.
Sure. Thank you, man. Sorry for keeping you up so late.
No, for you anytime. Thank you, mate. Thank you for tuning in to this latest episode of Trading Takes. Don't forget to hit the like and the subscribe button. And if you enjoyed this conversation, please check out some of others with some great traders. Thank you for watching.